Hey guys, this is Riado and welcome back to the channel. This is part 2 of my SoFi stock analysis, and if you're interested in watching part 1 where I talk more about the company and its growth numbers, you can find the link to part 1 in the description below. With that said, let's continue with the analysis. Now let's take a look at the company's profitability. Overall contribution profit, which is net revenue minus direct expenses, is $541 million in 2022, which is a 35% margin to adjusted revenue. And in Q1, contribution profit was $201 million, which is a 44% contribution margin. As you can see, contribution margin has been improving over the last few quarters, showing economies of scale within the SoFi platform, which is really great to see. And here we can see contribution margins from the different business segments. For the lending segment, contribution margin was 65% in Q1, which seems to be trending in the right direction. The CFO also mentioned that the improvement was driven by mix shift to higher personal loans revenue as well as operating leverage. Next, we have the tech platform with contribution margins under a lot of pressure over the last few quarters, with a contribution margin of just 19% in Q1. So contribution profit for the segment actually dropped 19% year over year to just $15 million, and this is likely due to one of its partners leaving the platform. The drop in contribution margin is also due to the acquisition of Thesis, which has a lower margin profile, and excluding Thesis, contribution margin would have been 28%. Nonetheless, management expects contribution margin for the segment to remain between 20 to 30% moving forward as the company invests heavily to capture growth opportunities across client verticals, products, and geographies. And finally, financial services segment is still operating at a loss with a contribution margin of negative 30% in Q1, and as you can see, contribution margin for the segment has been improving over the last few quarters due to better monetization along with economies of scale. And I believe this is the financial services productivity loop that is generating better unit economics for the segment. In addition, management also expects the financial services segment to be margin positive by the end of the year, which is really great to hear. And here we can see the rest of SoFi's profitability metrics. As of Q1, operating loss was $36 million, which is a negative 8% operating margin, and net loss was negative $34 million, which is a negative 7% net margin. Not much to talk about here, but SoFi is still unprofitable on a GAAP basis, but if we look at adjusted EBITDA, the company is already profitable ever since Q3 of 2020. I don't normally look at adjusted EBITDA, but in the case of SoFi, it is a good proxy for cash flow, and seeing that it's positive means that the company is generating cash. Whatever it is, profitability metrics are all trending in the right direction, which shows economies of scale and operating leverage, as well as the financial services productivity loop gaining momentum. With that said, SoFi should be profitable on a GAAP basis sooner than later, possibly by the end of the year or early next year. Turning to the balance sheet, SoFi has cash in hand of about $2.5 billion with about $6.1 billion of debt, which puts its net debt position to about $3.6 billion. And here you can see how net cash has trended over the last few quarters. As of Q1, SoFi also has a Tier 1 capital ratio of 17.8%, and this shows how leveraged SoFi is in relation to its total assets. And higher capital ratio means that SoFi is in a better position to deal with unexpected losses. For context, JP Morgan has a Tier 1 capital ratio of 13.8%, and Bank of America has a ratio of 11.4%, so that means SoFi is more liquid and less leveraged than these institutions, which is really good. Here we can see how SoFi's loans, deposits, and debt balance have trended over time. As you may or may not know, SoFi received its bank charter back in Q1 of 2022, which is when SoFi began accepting customer deposits in its checking and savings account. Consequently, SoFi can use those deposits to fund its loans, which is why the growth of debt has slowed down in pace, which is great to see. As of Q1, SoFi has $16.2 billion of loans in its balance sheet with about $10.1 billion of deposits. It is also worth noting that despite growing its loan portfolio so rapidly, SoFi maintains stringent credit standards and disciplined focus on quality borrowers. So the CFO mentioned that its personal loan borrowers' weighted average income is $164,000 with a weighted average FICO score of 747, and its student loans borrowers' weighted average income is about $173,000 with a weighted average FICO score of 769, which means SoFi's borrowers have have high credit scores and income that are less likely to default. The CFO also mentioned that delinquency rates and charge-off rates remain healthy and are still below pre-COVID levels, so overall SoFi is in a strong liquidity position. In terms of cash flow, it will not be useful to look at SoFi's free cash flow because SoFi is essentially a bank and banks grow by holding more loans in their balance sheets, which will negatively affect cash flow from operations under changes in net working capital. And since getting the bank charter, SoFi has been growing its loan portfolio as more and more customers deposit in SoFi Bank, and remember that SoFi uses customers' deposit to fund its loans. So it wouldn't be appropriate to look at free cash flow as it only takes into account the growth of loans held in its balance sheet without taking into account the growth of customer deposits in its balance sheet. That is why free cash flow is very negative as you can see here, while net cash balance is actually improving quarter over quarter. The better metric to look at in my opinion is adjusted EBITDA, which is a good enough proxy for cash flow, and as you can see, adjusted EBITDA is positive and is improving over the last few quarters. In 2022, adjusted EBITDA was 143 million, which is a margin of 9%, and in Q1, adjusted EBITDA was 76 million, which is a 16% adjusted EBITDA margin. So that is a good indication that SoFi is generating some level of cash. So on a balance sheet and cash flow perspective, SoFi looks financially healthy. Turning to the outlook, management provided the following guidance. Q2 adjusted revenue is expected to be about 475 million at its midpoint, which is about a 32% to 35% growth year over year. This is a deceleration from Q1's 43% growth, but the slowdown is expected as the company grows over a larger base. On the other hand, Q2 adjusted EBITDA is expected to be about $55 million, which is about a 12% margin, which is a drop from Q1's 16% margin, but it is still an improvement from last year's 6% adjusted EBITDA margin. For the full year, management expects adjusted revenue to be about $2 billion, which is about a 27 to 31% growth year over year, and adjusted EBITDA is expected to be about 278 million, which is about a 14% adjusted EBITDA margin. In my opinion, guidance is pretty underwhelming, which is why the stock acted poorly after Q1 results. But I think the return of the student loan payments in October is not baked into the guidance yet, so if the moratorium ends, we can see SoFi easily beating guidance. As you can see, student loan payments are expected to resume, but the Biden administration also introduced $10,000 to $20,000 in federal student loan forgiveness for those making less than $125,000 per year. As mentioned earlier, SoFi's borrowers have a weighted average income of about $170,000, so that means most of SoFi's borrowers will not qualify for the relief program. Therefore, we can expect SoFi to receive an influx of lending revenue as student loan payment resumes and students refinance their loans. Besides, management has a history of being conservative with their guidance, so it won't be surprising for them to beat guidance. In addition, SoFi has beaten analyst estimates in all its quarters as a public company, so I expect an easy double beat for SoFi moving forward. Here comes the most difficult part of this analysis, which is how do we value SoFi? First of all, SoFi has lost more than 80% of its value since its peak of $24 in November 2021. The stock also dropped about 30% following Q1 earnings results and a few analyst downgrades due to fears that SoFi is not selling the loans it's holding. And finally, the government announced that the student loan pause will finally come to an end, which caused the stock to nearly double within a few weeks. Now, SoFi stock is currently trading at about $8 per share, which puts its market cap at about $7.6 billion. The question is it a good idea to buy SoFi stock today? Well, that is a very difficult question to answer, but let's take a look at its valuation. If we look at its valuation multiples, we can see that SoFi has traded as high as 25 times its sales, but valuation have now compressed to just about 4.5 times its sales, which is a significant discount based on historical standard. Now that's the easy part. Here's the more complicated part. Should we value SoFi as a fintech company or a bank? We can't do a DCF model on banks because they have negative free cash flows, and so the only option is comparing valuation multiples with other banks. If we value SoFi as a bank, we can use price to tangible book value, which is a popular valuation metric for banks, and compare that with other banks, and in this case, the 5 largest banks in the United States. As you can see, SoFi is trading at a price to tangible book value of 2.4 times, which is a large premium to other banks. But SoFi is trading at a premium for a reason, which is that the company is growing much faster than all of these banks, so it is unfair to compare it to legacy financial institutions. On the other hand, if we compare SoFi with fintech peers based on a price to sales ratio, we can also see that SoFi is trading at the upper end of the range, but slightly undervalued compared to Robinhood, which is quite bizarre in my opinion. But again, comparing SoFi's valuation multiples to fintech peers is useless too, because their business models are not the same, their margin structures are not the same, and their growth profiles are not the same. And as you can see, SoFi is growing much faster than all of its peers. So that is the challenge with valuing SoFi, is that we can't do a DCF analysis and we can't do a comparable company analysis, and the company is not even profitable yet, so we can't use PE multiples as well. But fortunately, we can look at what the quote-unquote experts are saying. If we head on to Seeking Alpha, we can see that Wall Street has an average buy rating on the company with 7 strong buys and 1 buy, with 6 holds and 1 strong sell. And if we scroll down, we can see that the average price target is about $7.57, which represents a 6.7% downside from current prices. The highest price target is about $14 and the lowest price target is about $3. But again, analyst price targets are not that helpful and reliable either. On a side note, institutions have been selling SoFi over the last few quarters, which doesn't really give investors the confidence that they need. But the one thing that shows SoFi is undervalued is that CEO Anthony Noto keeps buying shares every single quarter. You know, insiders could sell for a variety of reasons, but there's only 2 reasons why insiders buy stock of their company. One is that they think the stock is undervalued, and 2, they think the stock will go up. That said, the CEO buying shares show that he has skin in the game and that he has high conviction in the long-term prospect of the business. Whatever it is, I think there are some catalysts that could push the stock higher despite the recent rally that we've seen. This includes 1, the student loans payments resuming, provided that the moratorium does not get extended. 2, the home loans business improving and returning to growth mode. And 3, improving profitability, and I think that is something that investors will like in this kind of market environment. But looking at the price chart here, we can see that SoFi has been trading range bound between $4 and $8, and if we zoom out, it seems like it's forming a similar pattern back when the company went public. There's the triple top that we've seen, and then a break of support to the downside, and today SoFi stock is forming the same pattern with a possible triple top again. And so the next few weeks will be important for the stock. If SoFi fails to break resistance, SoFi may trade sideways again, or worse, continue its sell-off below $4 a share. But if SoFi breaks resistance, which could happen tomorrow, by the way, I am recording this on Thursday, we could see a potential short squeeze as SoFi has a high short interest of 13%. So it will be interesting to see SoFi's price action in the coming weeks. Before I wrap up this video, let's quickly talk about the risks. While SoFi has a compelling value proposition of being the one-stop shop for all things finance, SoFi may be falling victim to being the jack of all trades, master of none. By spreading its resources among many different products, SoFi faces tough competition from specialized providers. For example, some people might prefer using Coinbase to buy crypto, or use Robinhood to buy stocks, or maybe use a firm's buy now pay later offering. These companies offer more features and unique experiences which some customers would prefer, which consequently limits SoFi's product growth and adoption. The biggest risk, of course, is regulation, and as you can tell, SoFi's stock is very volatile with lots of spikes and drops. That's because SoFi's stock is politically driven, not necessarily fundamentally driven. And the best example to this is, of course, the 3-year-long student loan moratorium, which is causing massive volatility in the stock. The stock drops every time there's an extension to the student loan pause, so if for some reason we see another extension, the stock could drop again. That said, the political and regulatory landscape are very unpredictable, which is one thing I don't like about investing in SoFi. It's like investing in Alibaba. On one hand, fundamentals remain strong, but on the other hand, delisting and geopolitical risks are putting immense pressure on the stock. Last but not least, continued deceleration of the business could re-rate the stock to a lower valuation multiple, which could add even more downside pressure to the stock. So the final verdict: SoFi has an amazing value proposition as the one-stop shop for consumers to manage their finances in a single app. The investment case for SoFi is very compelling. It has robust growth across all three business segments. It is turning profitable. It has strong management. It has strong technology, cost advantages, and switching cost modes. And it has a long growth runway ahead with the potential to disrupt an entire banking industry. Additionally, the end of the student loan moratorium could be the catalyst that turn around the stock for good. So there's a lot to like about SoFi stock. But here's why I'm not buying the stock. First, the company is incredibly complex. I find it very hard to understand the business, and it is also operating in an industry that I have very little knowledge about, which is the banking industry. And so I'm not afraid to admit that. Secondly, the stock is politically driven, and its performance depends on monetary policy and federal regulations, which are unpredictable, and that could make or break the company. And lastly, I'm not sure how to value SoFi. I'm not sure how to find its intrinsic value, and for those reasons, I don't have the conviction to invest in SoFi, and that's why I'm staying on the sidelines. With that being said, what do you think about SoFi stock? Are you bullish? Are you bearish? Please let me know in the comment section down below. And if there's a stock that you want me to cover in this channel, please don't hesitate to include that in the comments as well. Thank you guys so much for watching this video. As always, I appreciate you and I hope you have an amazing day. See you guys on the next one.